I see gold as the absolute necessity for anyone to hold if they're looking to preserve their wealth and assets over time. And it gets knocked all over the place with central bank intervention. But right now, the market's very heavily manipulated to try and keep the price down. So, I mean, the fundamentals there are wonderful for gold.
Hello, everyone, and welcome into CrushTheStreet.com. I'm joined today with John Williams of ShadowStats.com, an elder in the sound money movement, very respected for the work he provides, and for me, it's a pleasure to be speaking with him. He has been on the show before, no stranger to the audience. John Williams, thanks for joining me.
Thank you so much for having me.
Sir, last Wednesday, the CPI report for January indicated that price for goods and services rose by the most they have in 4 years. And on a year-over-year basis, the consumer price index rose 2.5%. And we have the 10-year real yield actually going in negative for the first time on a downside trend since May of 2011. Now, I know you're going to have some opinions and some analysis on this net of government adjustments, and that's what I want to ask you about today. Would you please break this down for us?
Sure. Well, keep in mind here that the volatility, almost all the volatility that we've seen in the consumer price index, the headline number of the last several years has been tied to big swings in oil prices and related gasoline prices. Oil prices collapsed in the second half of 2014. I think that was pretty much orchestrated by the U.S. as a way of creating financial stress for Russia, punishment for their activities in the Ukraine. If you look at what the administration said at the time, said, "Oh, we're not going to take any formal sanctions against Russia, but we will do it against individuals." In the same week that they announced some individual sanctions, oil prices started to collapse and the dollar started to soar, both of which were heavily manipulated. And as oil prices collapsed, so oil prices collapsed, the gasoline followed, our inflation followed. What you just saw in the CPI was the first time that we've gone, within the last month or two, of going positive year to year with the energy inflation numbers since that crisis. And that's why we're beginning to see multi-year highs in the numbers. We're coming out of an extraordinary inflationary downturn, and again tied largely to gasoline prices, and that's something that is it's not realistic in terms of the way people measure their cost of living. The government plays all sorts of games here. They've changed the reporting methodology over the decades, ranging from how they weight the inflation numbers in terms of substitution effects, and the way they value the weighting from a quality standpoint. Enough so that it knocks significant percentage points off the headline detail. I saw some comment today that the government's inflation numbers are confirmed by the billion, what used to be the MIT billion price project or such, where they would they survey all sorts of factors on the internet and come up with what they found in the way of price changes on the internet that was coming up close to the CPI. And I'm not saying that the government isn't accurately measuring the retail prices, as they go out and survey it. It's how they weight it and handle it after that fact. So it's not surprising that it would come in close with a big computer survey of what's on the internet. The problem indeed is how they weighted and how they adjusted for quality, and the internet survey on the prices is a little shy in terms of providing its methodologies in terms of at least of how it adjusts for quality. I presume there's some adjustment there. Let me give you some specifics and then tell you how it affects it. You go back, I mean, the Consumer Price Index, the concept goes back literally hundreds of years. If you want to know how inflation's going, the general reason you want to know that is so you can at least keep your income growing at the pace of inflation, if not faster. You want to be able to beat the pace of inflation with your investment returns. And what kind of inflation do you want to look at to cover those types of items for you? The traditional approach has been to look at inflation in terms of measuring a constant standard of the constant cost of living. Used to be that you might take, very simplistic here, you'd measure the price of a gallon of gas, a pound of steak, a loaf of bread, and then you'd price out those same basket of goods the next year. However much it had changed, that was the rate of inflation. That's what you needed to maintain the same ability to buy that same basket of goods. Well, if you go back to the 1990s, Alan Greenspan, who's then Fed chairman, was making some noises about how the CPI inflation overstates the rate of inflation. If only we had a more accurate number, we could cut the budget deficit. And if you asked him how the CPI was overstated, he'd say, well, suppose steak gets very expensive. People will buy more hamburger. If they buy more hamburger, then they're not spending as much and their cost of living isn't as high. But that's not measured in the CPI. And he was absolutely right. It wasn't being measured in the CPI because that's not maintaining a constant standard of living. The way you want to look at inflation, if this is from your personal standpoint, is that you can still buy steak if you want to buy steak and not have to cut back to hamburger because the steak's gotten more expensive. That was the whole concept of measuring the constant standard of living. What the government did was move the Consumer Price Index to a substitution basis, where they made all sorts of changes, and they've now come up with what they call a chain-weighted CPI that eventually is as things currently stand. That may change with the current administration, but as things currently stand, that's designed as the new CPI for adjusting things such as Social Security cost of living adjustments. And even as reported, the changes that they made since the 90s had made a significant dent in terms of reducing the cost of living adjustments for Social Security. Social Security checks should be at least double what they are now if these changes had not been made. And Greenspan's point very specifically was aimed at cutting the cost of living adjustments for Social Security. The other benefit from the government's financial standpoint, aside that they didn't have to shell out as much money, was that they could the lower inflation rate would also boost people to higher tax brackets artificially, and so they'd get more money there. My contention is, look, if you're trying to take money from the populace, do it the way it normally is done, by taxes, so people know it's happening to them. Don't put forth this nonsense about a redefined CPI that it cheats the public by stealth. It effectively is a tax, so that you don't get as much in the way of your cost of living adjustments that you should be. getting, or you have to pay more taxes. Just raise his taxes. Be honest with the people. The people can understand that. But
I love
it's
it,
even
John.
worse than what they did with the substitution, because this whole process started back in the 1980s, where they came up with the idea of adjusting for quality changes with the prices. Now, there are legitimate ways that you adjust for quality with inflation. For example, the Bureau of Labor Statistics sends out their thousands of people surveying prices each month, and they'll check very carefully all sorts of products. And they'll find, let's say there's a candy bar. One month it's an 8-ounce candy bar in a certain size package. If the next month it's still the same size package, but it's, let's say, a 4-ounce candy bar, they've changed the labeling on it, they should pick that up, and it'll be priced accordingly in their formulation. They'll adjust the price for the fact that you're only getting half the candy bar that you're getting before. That's a legitimate quality adjustment in terms of the CPI.
John, let me jump in right there. It's amazing how that happens. And of course, it happens so slowly that we don't notice it, or at least the average person doesn't notice it. But, of course, you see it happening in plain sight. But I just want to ask you now, where are we versus the numbers that they reported last week? And where are you seeing the current CPI numbers? And are they is the real yield even more negative than we are being told by the government?
Well, it is. If you want to look at inflation from a personal investment standpoint, where you want to maintain minimally a constant standard of living, or at least looking at inflation as what's needed to maintain a constant standard of living. The way the average person would view it ranges from 3 to 3.5 to 7% higher, and the range there depends on how you want to look at some of those quality adjustments, which I think should have to be taken into play. And that's actually where the biggest changes are. But just with the substitution, you're looking at something at around 3%, which is over time. Well, right now it more than doubles the annual rate of inflation, and if you get the other up, you're up around 10% when you take in all these what they call hedonic quality adjustments. They adjust there for quality changes that the average person doesn't recognize, doesn't see, can't be quantified, like a candy bar that's been cut in half.
Sure.
These are things that they say, well, we know this is a better product than it was before, so we've come up with computer models to estimate how much better it is, and thus we reduce the rate of inflation on that product accordingly. A big area there is a computer. There are legitimate issues. Certainly a computer today does a lot more than it did 10 years ago or 20 years ago. But the issue there is how they measure it, how they report it, and how the average person views it. I'll give you a personal example. I'm an old guy, and I'm not real high tech. I use my computer very simply for effectively word processing and working with my numbers and making graphs and such for my newsletters. I don't watch television programs or movies on it. I don't need all that, a lot of the real high-tech stuff that comes with it. About 5 years ago, I needed to replace my computer. I'd bought a computer 10 years before that I was replacing. And say 10 years before, it had cost me $1,000. I went out to replace the computer. I was able to replace it for about $1,000, getting pretty much the same stuff that I needed. Of course, there was all sorts of issues there. I had to learn how to handle different versions of certain programs and such. I really didn't like the changes, but I did need the new computer. And this had all sorts of wonderful expanded memory and all sorts of games, none of which I needed. Now, I was out of pocket $1,000. But the way the government measures the inflation rate, I should have been able to buy that computer. The computer that had once cost me $1,000, according to their calculations, I should have been able to buy for $50. But I couldn't buy that for $50. Nobody sold a computer like that anymore. But for my the uses that I used to replace that computer that I bought for $1,000 10 years before, there's no chance I could buy it for $50. Yet in my consumer price index adjustments, it was reflected as though it only cost me $50 instead of $1,000 out of pocket. $1,000 I was comfortable with. From what I could see, and this is what I'm getting back in terms of the common perception. The computer didn't cost me any more than it had before, so I didn't see any inflation there. I didn't see 95% deflation, which is all in quality adjustment.
Well, that is a real clear example. John, one of the things that we know is that when inflation kicks into gear and real rates go negative, historically we've seen gold rise. Even in an interest rate, a Fed funds rate rising environment, and one of the most recent examples here was from 2003 to 2007. The interest rate started at 1% and gold was at $346. The Fed raised rates to 5.25% and gold spiked to $651. Given this and the current situation we're in, could we potentially see a repeat of some of these times in history where gold goes up simultaneously with the Fed raising interest rates?
It could happen. I'm a gold bull from way back and going forward. I see gold as the absolute necessity for anyone to hold if they're looking to preserve their wealth and assets over time. It gets knocked all over the place with central bank intervention, and it's very heavily. But right now, the market's very heavily manipulated to try and keep the price down. So, I mean, the fundamentals there are wonderful for gold, but there are people, and I'm talking very specifically central banks, that have an interest in seeing the gold price being contained as much as possible, who will hit the markets and knock them down in periods of great volatility. So where I'm very bullish on gold, when you buy it, you have to hang on to it. I see a circumstance here, and a likely circumstance even with the new administration, unless something's done to address the long-term solvency issues of the United States, the dollar ultimately will become worthless, and I think that can happen very quickly. And as it becomes worthless, that gives you the upside movement in gold. Because gold is effectively maintaining the purchasing power of the underlying assets. It protects you against inflation. The reason that interest rates usually rise is due to higher inflation. I mean, if we have inflation now, say 2.5%, that'd normally put the 30-year bond up over 5.5% movement on 6%. But that would be normal circumstances. These markets are very heavily rigged and controlled right now by the Fed. Extraordinary distortions from their quantitative easings, which I don't think they're necessarily out of, and all the games that are continuously being played with the stock market to keep it propped. I see that as a house of cards. There's good reason for optimism on the economy right now with a change in government, but the stock market was already very heavily overvalued, and a good reason for rally. But I'd rather see the rally from down 10 to 15,000 instead of 20,000 on the Dow, to have any hopes of having something that's sustainable. Very difficult circumstance from an investment standpoint. Nothing is safe in the short term, but the long-term gold is your bet, because that provides you the long-term stability and store of wealth.
Sure.
As over the decades and millennia.
John, when it comes to
but physical gold, not these electronic.
John, when it comes to inflation, it's been talked about quite a bit that the U.S. is exporting their inflation. We're printing lots of dollars and exporting it overseas. And I want to kind of get your thoughts on how our inflation is affecting other countries around the world.
Well, the problem here is that the banking system effectively collapsed in 2008. And the central banks, the Fed, let me put it this way, what the United States has been leading the way here, we took the markets to extreme. We introduced all sorts of gimmicked instruments that, as long as you didn't have an economic collapse, would work fine, and you could package all the bad debt of banks and go out and sell that as investment-grade securities. Nobody thought the economy would, nobody, the popular opinion was the economy was under control now that the Fed and the government knew how to handle it. So you didn't have to worry about those things. And obviously, as the economy started to turn down, and the housing market led the way, it had a terrible effect on all these derivative instruments that were heavily invested in by the financial community. The system came to the point of collapse in 2008. The Fed and the U.S. Treasury made the decision very simply, and I can't say that I argue with their decision, although we shouldn't have been where we were. I mean, where we were heading was foreseeable. Terrible mismanagement by the Fed and the Treasury, the U.S. government, the politicians over time, fiscal irresponsibility. And with the Fed, meeting the needs of the banking system, coming up with all sorts of new and creative debt instruments that enabled them to expand their lending and to leverage lending on top of lending. They needed to have the debt expansion to grow the economy, because personal income was shrinking if you adjusted it for inflation. And if you don't have real growth, inflation-adjusted growth in income, it's very difficult to get inflation-adjusted growth in the economy. So all this was done to keep buying economic strength, to borrowing the economy from the future. That's a system that will lead you to collapse. That's what we had. And they created whatever money they had to do. They did whatever they had to do. They bought whatever entities they had to buy or bail out or guarantee, lend whatever money they had to do to prevent the system from collapsing. And they prevented the system from collapsing. But in the process, all the measures they took that were stopgap, they pushed the problem a little bit into the future, but the problems they addressed were not the fundamental problems that had driven us into the crisis. They did not address the economy. They did address the solvency issues of the banking system, but it hasn't worked well. You're still not getting normal lending in our banking system. The big problem with the dollar and where we're going here is the long-term insolvency of the federal government. If you look at not just the headline federal deficit, but if you look at the government's own accounting, where they use generally accepted accounting principles to show the deficit, and when I talk of that, the way the deficit gets reported is just a cash in, cash out basis. So if, let's say, you have have a big payroll. September 30th is the end of the fiscal year. So let's say your September 30th payroll, federal government payroll, falls in October. You don't have that in the last fiscal year, so that makes your numbers look better. In GAAP accounting, it moves things around so that everything's where it should be. So that where they had something in the 500 to 600 billion range in the deficit last year, that was something like 1.5 or 6 trillion adjusted for normal accounting principles. But the big problem is what's been done in terms of long-term liabilities. The government has looked to fund Social Security and Medicare in particular without not to fund them effectively. The liabilities, the obligations that are set there now to meet the current system, what's obligated to Social Security and Medicare is unfunded into the future. I mean, there is some funding, but it's shy in terms of net present value. Effectively, the cash that you need to have in hand today to handle the system by more than $100 trillion. And there's just no way that can ever be covered. Now, Alan Greenspan, again, former Fed chairman, at the time of some possible talk of U.S. default, said, "Oh, that's not a problem, never going to happen, because the U.S. government can always it prints dollars. It can print whatever dollars it needs to pay its debt." And he's absolutely correct. And that's how you end up with a hyperinflation. So that you get down the road there, and the U.S. government doesn't have the ability to pay its obligations by raising its borrowing. It either defaults on its debt, which they don't want to do, or they do something which is its a financial equivalent. They start just printing the money and using the money that they're printing to pay off their obligations. We've seen a little bit of that with the quantitative easing. This post-2008 crisis, the system effectively fell apart. They haven't been able to put it fully back together again. Things are not operating normally, and that the quantitative easing there, which where the Federal Reserve bought something like $2.5 trillion worth of U.S. Treasuries, that they effectively monetized that debt. They effectively just created that money to pay. One effect was to pay the federal government's obligations. What they were buying there effectively covered 3/4 of the new debt issuance, a public debt issuance by the U.S. Treasury, and the Fed's holding that. They're not about to liquidate that $2.5 trillion. They keep rolling it over, buying more debt so that they hold that $2.5 trillion, and the interest that they're earning on that, they give back to the Treasury. So they've effectively fully monetized that $2.5 trillion. That's very inflationary. And I'll contend that the economy is not as good as reported, that in fact, it's turning down again. And then we're going to have a problem there in the next several months, enough so that the Fed's going to back off its pledge to now, which it keeps doing anyway, to raise interest rates. Raise interest rates, that keeps the dollar strong. The talk of jawboning, the higher interest rates, keeps the dollar strong. But the reality is that the Fed is going to have to move back towards quantitative easing because the weak economy hurts the banking system. Banking system's still not operating normally. Weak economy is going to hurt the banking system. The Fed's going to go back towards quantitative easing, as I view it. And as they do that, where all this talk of higher interest rates has propped the dollar against the rest of the world, because the rest of the world hasn't moved to raise interest rates. They're still effectively quantitative easing, or actually have gone with negative with their interest rates. The Fed is going to have to go back to that quantitative easing, and as they do, you're going to see a massive decline in the dollar, because that's the prop under the dollar, and with that, you're going to see a surge in oil prices and gasoline prices. Right now, we're seeing oil and gasoline higher At this point, particularly tied to some OPEC actions, cutting back on supply. But as the dollar starts to fall here, that'll automatically prop the oil prices. They won't need to be cutting back as much on their production to keep prices higher. And as the oil prices and gasoline prices rise, where that kept our inflation, the headline inflation, under control the last couple of years, we're going to see that inflation really take off. And very possibly because of the concerns of the long-term solvency of the federal government, unless that can be brought under control, the currency markets will go to town on that and really clobber the dollar, and I think that'll give us the early stages of a hyperinflation as the rest of the world increasingly moves out of the U.S. currency.
Well, you heard the warning here, everyone. John, thanks for coming on the show with me today. If people want to learn more about what you do and your website, please share a little bit about that.
My website is shadowstats.com. I have a weekly, at least once a week, electronic newsletter for subscribers that then analyzes the current circumstances, the current data. I not only look at the CPI reality, but also the underlying economic reality, where we've been generally getting overstatement of economic activity, understatement of unemployment, areas such as that. But I also have a lot of material there for non-subscribers that gives you background information on the different reporting problems and where reality is. Always have a list of the headlines in the newsletter so you have a sense of what's being discussed. And we always enjoy getting new subscribers. An annual subscription runs $175, 6 months for $89. And we welcome anyone who'd like to join us. But again, anyone who wants to get basic background information, that's available on the homepage, shadowstats.com.
Sure. John, thanks again for coming on the show. It's always a pleasure to speak with you. Take care, sir.
Thank you, and thank you again for having me.